Modani, part of fixed income investment team at Mirae Asset Mutual Fund, managing Mirae Asset Corporate Bond Fund. In the after effects of COVID-19 accommodative monetary policy, we saw inflation reaching previously unseen levels across the economies. So, to fight the increase in prices and to tame inflation, central banks commenced on a rate hike cycle. It's been 2 years since central banks increased the key policy levels at the fastest pace and are now paused at a multi-year high levels. So I think this current pause may present an opportunity to look at an asset class which previously faced the brunt of the fastest rate hikes. Historically, it is observed that the period marking the end of the monetary policy tightening tends to favor fixed income asset class or debt asset class. So let me speak when spread between earnings yields to bond yield increases, it is the equity asset class which is more attractive. But when the spread decreases, it is the fixed income asset class which is attractive. Currently, the spread is at below its long-term average. If we map the spread to historical repo rate increase decrease, it tells us how period before the end of monetary policy tightening acts as an entry point for looking at the fixed income asset class. Moreover, I think further, using 10-year GSEC with 5-year AAA corporate bond yields, the spread becomes more attractive, indicating that corporate bonds have an edge among the fixed income securities. Before we go to a specific mutual fund, for better understanding, let's see how rate cuts impact the debt mutual funds. So when typically interest rates are moving up, bond prices go down, impacting the NAV of the debt mutual funds negatively. However, when interest rates are going down, bond prices move up, impacting NAV of debt mutual funds positively. When interest rates decline, looking at debt mutual funds makes sense as the portfolio holds the underlying instrument at a better or higher rates. Currently, we are at the peak of existing rate cycle. So entering now may aid in taking the advantage when interest rate cycle goes for a rate cut. Now let's see what happened last time when policy rate went for a cut. From Jan 2013 to December 2016, the repo rate was reduced from 8% to 6.25% incrementally. Corporate bond fund category was able to take the advantage of the rate cut cycle. The same can be seen in investment experience as well, wherein corporate bond fund as a category gave a minimum of 8.4% returns and maximum of around 11.6% returns with an average return of around 9.6% returns. Therefore, I think corporate bond fund category makes a good case for investment.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.